let's say the guy's name is Bill, who's trying to raise capital. You know what stands in Bill's way?
What's that?
Bill.
Exactly.
Welcome to the Fueling Deals Podcast, the podcast that teaches how to accelerate your business growth through all types of deals. It's time to fuel up, so buckle in with your host, Corey Kupfer.
There are only two ways to grow your business: organically through sales, marketing, providing great service, etc., and inorganically through deals. Too many companies focus only on the first way, organic growth. Welcome to the podcast, which will accelerate your business growth inorganically. My guests are a huge variety of deal makers and experts on all types of deals who have personal experience that will help you grow, get clear, learn best practices, and avoid mistakes. We discuss everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My guest today is Joel Block. Joel is a money business insider, a long-term venture capitalist and hedge fund manager. And this is the part of his bio that I love. It says it's gobbledygook for professional investor, which is really what Joel is. He lives in a Shark Tank world like on TV. Since selling his publishing company to a Fortune 500, Joel keynotes conferences worldwide, delivering business strategies and the inside track for money and success to business executives and their teams. I know Joel through the National Speakers Association. He's the immediate past president of the LA chapter, and he and I have gotten to know each other through that. And I'm so thrilled to have Joel on the show. Welcome, Joel.
Hey, Corey, thanks very much. How are you?
I am great. It's great to have you here because, Joel, you have a particular experience and expertise in the hedge fund world, but really, more broadly than that, you understand the path to the money is often the way you say it. And there are so many entrepreneurs and growing businesses and larger companies who, frankly, can do a lot better at that. So I'm really thrilled to have your expertise for our audience.
Well, listen, I love the entrepreneur business. It's been very good to me, and I do what I can to help other entrepreneurial and privately held companies to be the best that they can be. And the one thing that most people really are not able to grab onto, which is your area, is the whole area of capitalization and deal making. And I mean, listen, I do it every day. That's how I make my living, and that's how I get my job done. But most people don't understand it. So let's bring some of that info to them, to the people who need it.
Absolutely. So before we delve into that a little further, though, I want to take you back, and I want to, when you were growing up, what did you want to be growing up? Because my guess is it probably wasn't a hedge fund manager.
It's so funny you say that, because I always make a joke that when you're 10, you don't want to be a hedge fund manager. But when you're a little older, it's a pretty cool thing.
Right. So what was it when you were growing up?
Well, when I was probably till I was about 10, I wanted to be a doctor. And I don't know why that kind of fell away, but I really ended up not being that great in advanced math or chemistry or biology. I didn't really have any interest in those things as I got a little older. And by the way, I'm a CPA. I started in the CPA business. I haven't practiced in a long, long time. And contrary to what many people think, CPAs are not great at math. They're great at arithmetic. So CPAs aren't really much of mathematicians. But I don't really remember what I wanted to be after about age 10 or 11. I don't really remember. But and maybe I didn't really know through college, which is why I didn't do that great in college. But when I got to Price Waterhouse doing tax work, that's when I figured it out.
Got it. And then however you define this, what was your first real business?
Well, I did my first little deal when I was about 10 years old. Me and another guy bought a little mini bike. We fixed it up and we sold it to another kid.
I love that. So,
it's like it had a motor on it, and somebody's parents helped us to get the motor going. And I don't know, we probably bought it for $5 and sold it to somebody for 10. And that was, money came out of thin air, which was very, very cool. And I didn't understand why that happened, but it was awesome that it did.
I love that. A deal that you're at 10 years old, and you also learned about your first business partnership, huh?
And you know what? It was successful. We didn't have a contract, and nobody hit each other.
That's awesome. I love it. So just give us a couple of more minutes on what you are doing now. And I know, there's been somewhat of a transition. I mean, I know a hedge fund manager, seminar company, and now you're doing a lot more speaking and training and that kind of stuff. So give us a little detail there.
Well, listen, I was in venture capital for a long time. I started after Price Waterhouse. The last deal at Price Waterhouse that I worked on was a giant real estate syndicator. I was doing the tax work. I was a young kid, but I was involved on a team. We were doing the tax work where we were converting the books and records of 500 partnerships into tax returns. And it was dreadful work. I just hated it. But I loved reading the partnership agreements, and I knew that I wanted to be a deal maker like the guys that were running these deals. So I quit the firm and I went in that business. I started a little company. Me and another guy, we just found a building and we cold called a bunch of doctors, and we broke every security rule that there was, but that's how we got started. And from there, I did a series of deals, and then I fell into a venture capital transaction in 1990, about 4 years later. And then from there, built a company that we delivered stock quotes to investors by fax. And I got a large company to put up $10 million to back this, and went to Wall Street, started selling subscriptions. And by the way, not all the investment was in cash. A lot of it was advertising credits and the things that we would have used the cash for. So we got a lot of strategic support from this organization, and I sold the rights to use our service to one of the big Wall Street brokerage firms, and we got like 35 of the nation's biggest newspapers to promote it around the country. It was a pretty well-known deal at that time. Then I ended up selling it to a Fortune 500 company, and then just started doing deals after that. I was buy and sell companies. So I've been involved in about 40 different transactions, and then started a fund when things were going really south in the late 2000s. I started a fund to buy distressed assets. And about the same time, in about 2008, I got a call from an executive of one of the biggest real estate companies in the country. And the guy said, "Hey, listen, we found you on the internet. Can you come out here and show us how to raise capital to buy real estate?" And that kind of gave birth to the syndication and hedge fund symposium that I do twice a year, where I teach real estate fix and flippers and guys that want to learn how to raise capital, how to structure transactions. I teach these guys how to do this and really raise their capital the way Wall Street does, and to really kind of take it up a notch. So that's kind of a secondary thing that kind of just came out of thin air, but it's turned out to be a wonderful network of people, and it's been awesome. So those are really the two main things. And now, as I get ready to retire from my hedge fund, I'm doing more speaking, and I'm invited different places. So I talk to companies about how to get the inside track on in their business, how to be the best they can, how to draw the shortest line to the money, and really how to just do a good job in what they do.
So there's a lot in there that can really provide value to our audience. So I want to go back to that first big deal you did, that $10 million investment. Chunk of it was in kind, right? You were a relatively new company. You were, a comparatively young guy. How did you make that deal happen?
You won't believe this. It wasn't even a relatively young company. I didn't even have a business plan. I didn't have anything, but I had an idea. And the idea was so compelling, and it was so exciting, and I was so excited about it that the executives in this company got as excited as I did. And that really is the name of the game, is you have to genuinely be excited about what it is that you do. You have to genuinely believe in it. If it's just a transaction, you'll get something, but you're not going to get a lot. If you really want a lot, then you have to really demonstrate that you have what it takes to go the distance, and that you're not going to burn out on this, and that you're not going to just go south on it. So this company really believed that I had something, and I didn't understand their needs at the time, but they had very strategic needs for what it was that I brought to them. And by the way, they weren't the first company that I brought it to. I probably showed it to 100 companies before I showed it to them. I just was cold calling and going to conferences and trade shows and trying to get people to see what this was, and this company just really liked it. And it turns out it's because they had some competitive problems with some other people in their industry, And what I brought to them was a great solution to their problem.
Oh, that's great. And that points out something, it's interesting because a lot of your later career you spent raising capital and I always, there's this discussion between just capital, straight money, and strategic advantage, right? And there are strategic buyers and strategic investors versus financial investors and some hybrids. And so, I'd love you to talk a little bit about that because that obviously was a strategic arrangement back then.
Listen, if you can get strategic money is always fantastic. And actually, a lot of companies, large companies, Intel, Microsoft, a lot of the big tech companies have started, almost like incubators to make strategic investments in all kinds of companies. I mean, this has become very popular where these big companies, they are looking for alignment. And I understand from, I go to venture capital conferences and I'm still around a lot of these guys, even though I'm not in the venture business so much anymore. But these big companies are not demanding terribly onerous terms. I mean, they may have a first right of refusal, but they're not tying you up in knots the way the venture capital companies do. These big companies who are these big strategic investors, they are really looking for companies, even some of the airlines. I mean, JetBlue, I think, does some of this stuff. And I mean, companies are looking for ways to be innovative, ways to grow, ways to get their arms around some new ideas. And, listen, the way the ecosystem works, little companies innovate, big companies operate. And we just work together that way. So little companies come up with all these ideas and big companies buy those ideas and make little guys rich. And that's the way that it works. And then the big company who got the idea that we came up with then takes it to whatever the next level is going to be for them or for that idea. And it's a very good synergy. It's not, you can't always count on this kind of capital. It's not always the best capital. You probably will get better pricing on strategic capital because there's another incentive for the investor other than just their straight return on investment in a cash sense. So you'll probably get better terms. You might get less expensive capital. But on the other hand, you might get some great partners for life. I mean, hey, listen, the company that invested in me all those years ago, I'm still friends with a couple of the senior executives that worked with me years and years ago. So it's quite extraordinary to have friends from 25 years ago, from these very large companies that now are retired and, that are kind of far along in their life or their career. But, we've all kind of grown up together and that's, part of it. So it was a great way for me to make a lot of nice friends.
Oh, that's great. You've trained so many people who are looking to put funds together to raise capital, to invest in real estate and other things. And, you have a great sampling of the ones who've been successful, the ones who've been not successful. What stands in the way of the people who are not successful, and what are some of the tips the successful people should know about raising capital? Because it seems daunting to a lot of people who don't live it every day like you.
Well, let's say the guy's name is Bill, who's trying to raise capital. You know what stands in Bill's way?
What's that?
Bill.
Exactly. So say more about that.
Raising capital is an art form, but there are very specific things that people can do. Somebody who's done about 15 or 20 deals reached out to me this morning and they said, Joel, we're kind of going to the next level. Would you take a look at one of my deals and tell me how to fine tune this? And because they reach out to their attorney. And the first thing I said, look, I never, ever let the attorney structure the business arrangements of the deal. I give them the business arrangements, the terms that I want, and then they write it down correctly. And then they also put in all the legal terms. I don't ever tell them how to do that part, but I never let them work on the business terms. So as I'm reading this person's operating agreement and some of their documentation, the operating agreement really describes the relationship between the manager of the deal and the investors. This manager has left so much stuff on the table because whoever helped her put this deal together didn't know to ask for a lot of things that they probably need or should have put in the deal. They didn't put in fees. The way that they did their capitalization, their waterfall, the way the payouts work, really is not investor friendly. Now, Some people would say, well, that's fine that it's not investor friendly. That protects the promoter. But here's the thing you always have to balance. You always have to balance giving a good deal to the investors and getting a good deal for the promoter, whoever the promoter is, whoever the company is that's raising the capital. Because if the terms are onerous or they're unfair or they're not investor friendly, then the investors aren't going to contribute the capital. And if they don't contribute the capital, then you're not going to be successful as the promoter who wants to raise the money. So it's not in your best interest. I've had many, many situations, almost everyone, the attorney has overstepped and given advice that they shouldn't be giving advice. And that is always business advice because that's not what attorneys are supposed to do. But there have been situations where somebody said, "Yeah, no, we've got great materials, we've got a great deal, everything is terrific. So how are you doing?" We haven't raised any money. Well, why not? No, they don't know. And when they tell me what the deal is, frequently the terms are so ridiculous that no level-headed investor would move forward. And that's a really important thing to understand is whatever industry you're in, whatever business you're in, whatever activity you're doing, you have to talk to people who understand your space to give you a little bit of guidance on what relevant deal terms are going to be. So when you go to investors, I mean, you might find a couple of stupid people that'll give you the money, but they're going to give you smaller clumps. The second you get into bigger clumps, and a bigger clump is anybody that puts in, let's say, 250,000 or more. If an individual person is going to put in a couple $100,000, they're probably going to call an attorney. And the attorney's going to look at the deal and they're going to recognize that it's one-sided, and they're going to recognize that there's problems. If you want even bigger money, and again, we're talking about preferred equity. We're not talking about going to a lender who's going to loan you secured assets and tie up your house and your business and all your stuff. We're talking about equity money that generally is unsecured and comes in some other form. So deal structure is really, really important, because that'll sandbag your sales effort right away. Then you have to really understand how to talk to investors, how to talk to people about the things that matter to them. It doesn't matter what matters to the deal maker. It doesn't matter what matters to me or the business owner who's trying to raise the money. What matters is that the person who's going to give you the money understands what you're going to do with it, why you're doing it, and what's in it for them. And, believe it or not, Corey, one of the things that is so prevalent is that, the investor asks a very simple question. In other words, you describe the deal, you tell them how great your company is, you tell them how great all the things you're working on are, and the investor says, "Wow, this really sounds great. So if I give you my money, what do I get?" And you'd be surprised how often people don't understand the deal that the attorney has written for them. They just don't understand the terms. Now, I'm not saying you have to understand the nooks and crannies. I mean, that's your job as an attorney. But you have to understand the investment terms. In other words, you're going to get this percent, you're going to get this percent, you're going to get this when you're going to get the money and how it's going to work. You have to have some understanding of your deal. And I can't tell you how often people don't understand the terms of their own deal.
No question, Joel. I mean, I think that's a great point. And similar to that, I also find that a lot of people don't even understand their own financial statements, their own existing financial statements. And one of the things I always say to people, and listen, this is not, as an attorney, this is not my area, but as a deal attorney who really does have, a lot of experience in these things, I point out some of these things to other people, say, you got to go get help on this. And, what I say, so I'll ask them, for example, when I see financials in a, whether it's in a private placement memo or an executive summary, or they're just raising money from friends and family or whatever it is. And I say, well, what are those projections based upon? And they can't tell you. And what I always say to them is, listen, the investors care a lot less about your numbers. They actually care about your footnotes and your assumptions and how you came to the numbers, so that they can not only validate them, but know that you actually thought through it. And if you're not facile with that, these guys run themselves into trouble. So, it's a similar thing, right?
Well, yeah. And this kind of falls into, a kind of a third category, and that is that you have to know who your prospective investors are going to be. If they're going to be very unsophisticated people and you're going to get your money $50,000 at a time, then maybe you don't have to have good answers. But if you want to go up to the next level and raise your money 100,000, 200,000, 300,000, and in the private placement business, that's kind of where I work. that's we work between 100,000, let's say, and 500,000. I mean, sometimes it's a little more, sometimes it's a little bit less, but more or less that's kind of the ballpark. We don't work with institutional people who are putting in 20, 30, 50 million at a time. That's not our space. So, we're raising on private placements, from generally higher net worth people. And you have to know what kind of people you're going after. Because if you're going after somebody at the $200,000 mark, they may not go to an attorney, but they probably have enough experience that they're going to be able to ask some decent questions. And you better be ready for that, because if you can't answer their question, then that's not being respectful to them, their time. If they don't ask any questions, then hey, that's up to them. But if they do ask some questions, and you will absolutely have people that do, you need to be able to give them their answers. And as you can imagine, Corey, I see a lot of private placements. I've got a lot of deal flow. There are people that call me all the time. Hey, Joel, would you look this over for me, or just give me an idea about what you think? I saw one last week that was so complicated that I couldn't really follow it. It was like an incubator. So this company was investing in other companies who invested in other companies, and it was so complicated. And that's another important lesson, is you want your deals to be simple enough that people can understand them. Now, just the nature of our business is complicated, so you can't help that. I mean, an operating agreement is complicated. A sale of securities is complicated. And attorneys like you do this kind of work that put these things together. But the fundamental deal doesn't have to be complicated. That can really be pretty simple. And if it's not simple, then you're really not going to be able to get people to understand it. If they don't understand it, they're not going to do it, because a confused mind always says no. That's always well known, and you don't want to put yourself in that situation.
Absolutely. Hey, Joel, I want to go in a little different direction here, just in the last couple of minutes we have before we start to conclude. And that is, you and I, a couple of days ago, I was fortunate enough to have a cigar and a drink with you. And one of the things we talked about were these opportunity zones out of the new tax law. And, this is not going to air for a couple of months, but it will still be very, very relevant then. So can you just give a high level, not only with regard to the 1031 exchanges, which you can mention, but how it affects business people as well, and what the opportunity is there that a lot of people may not know about?
This is the most remarkable tax shelter in United States history, probably the greatest tax shelter in United States history. It was snuck into the Trump Tax Act of December 2017, so the Tax Cuts and Jobs Act of 2017. And what they basically said was, look, we want to move money from wealthy people into distressed communities, because the Trump position is that the private sector does things better than the public sector. So let's get wealthy people to move money into these distressed areas that'll fundamentally help the economy, that will fundamentally increase the number of dollars that are moved into the treasury of the United States government. And it will help the states. It will help real estate all over the country. And so it's a very good trickle-down, supply-side kind of approach to how all this stuff works. And so what they basically said was, if you have money that's in a 1031 exchange, capital gains that are not taxed, or let's say you do a stock transaction. Let's say you bought Amazon stock 5 years ago, and now you made $1 million, let's just say. If you take the capital gain that you made that has not yet been taxed, whether it's from a 1031 or whether it's just a straight transaction, long-term, short-term, doesn't even matter. If you put that money into an opportunity zone, and these opportunity zones were defined by the state governors of each state nominated different locations in their state. They submitted the list to the IRS. The IRS confirmed it. So these are census-designated places that are distressed, low income, and so forth. So they identified 8,700 of these opportunity zones. And these opportunity zones are eligible now to receive this capital that hasn't yet been taxed. So if you take money and you put it into an opportunity zone, two things are going to happen. Number one, if you hold it there for 10 years, let's say this, 5 years, some of it goes away. 7 years, more tax goes away. But at the end of 10 years, 100% of all the tax from the investment that you put into the opportunity zone is completely abated. Then any money that you made during that 10-year period of time on the new investment is completely abated. So you get a double whack. And here's the other thing is this is almost like a roadmap to a great investment. Remember, I'm a professional investor. I mean, that's my thing, right? So the government says, we want you to pour money into these 8,700 areas. There's a pretty good chance that these 8,700 areas are going to have a little bit better growth than everybody else does, because there's going to be a lot more, infusion of capital. And so there'll be a lot more demand for these properties than in other places where they don't have this mandate from the government. And because the returns are going to be artificially high because there's abatement of all this tax, there's going to be tremendous growth that's greater than what the rest of the economy does. So even if you don't have the tax benefit of a 1031 or other capital gains, there's still going to be fantastic growth from an investment point of view in some of these lower income areas. So just you can't do this personally. This is not a personal deal. You either have to do this in an LLC, a corporation, or even better, to go into a qualified fund, because you don't just put money in, paint the building, and say, okay, now give me a discount. That's not what it is. The government wants substantial improvement. And a substantial improvement means if you buy a piece of land for $1 million, you got to put in another, let's say, $500,000 into redevelopment, rehab, something of that building. So it's really for development and substantial rehabilitation.
So this is great. I mean, and when I follow the logic on this through, and you always talk about profiting from the inside, which I love. That phrase that you use, and it's a big part of what you do. Obviously, people who have pent up capital gains in 1031 exchanges or in other things that they own, there's a huge tax benefit. But what you also said was, even if you start something new and you have no pent up gains that you can benefit from, that the gain on over the next 10 years from the new thing you start in these opportunity zones is also going to be tax free. It'll be waived at the end of 10 years completely. And then even if you, in my mind, the other thing is, if I think smart people are going to start paying attention to where this money is going, which of those opportunity zones, there's a concentration of money going, because obviously, if you either buy real estate or start businesses or, things in those zones, and a lot of those areas need, more business and commerce, et cetera. You're going to be able to piggyback on the increased economic opportunity there. So I think there's a lot of opportunity for all types of people up and down the spectrum.
Well, then back to the topic that we're on, which is raising capital. Raising capital in these opportunity zones just got easier, because if you start a business or you have a business, you move your business to one of these opportunity zones, people are going to be inclined to invest in those areas, and so your ability to attract capital increases. And, the Treasury regulations haven't yet been finalized, so there's some questions about what happens. But put it like this. Let's say a venture capital company invests in a company, and, a couple of years later, it explodes, and now, whatever it is, they made a couple $1 billion. That couple $1 billion is probably going to be exempt from tax because it got made in an opportunity zone. So it's not just regular people. It's businesses, it's private equity, it's venture capital. There's going to be a lot of action in these opportunity zones. And, you talked about my show, which is Profit from the Inside. This is the inside track that people just aren't going to hear about for quite a long time. So your listeners, Corey, are kind of getting the inside track on something that most CPAs, most attorneys have not heard about, because it's still a little bit formative. Money's starting to pour in, but the final rules aren't even addressed yet by the IRS. So that'll happen probably in late January.
So that's great, Joel. And I think that's a great thing for our listeners to start paying attention to. Certainly, if they haven't heard of it yet, definitely read up on it. So Joel, there's a few things that we've mentioned. I want people to know how to reach you, generally, where they find out more information on you. I know, you have your own podcast. I know you have a white paper on this opportunity zone stuff. So where do people find you and all that information?
Well, for speaking and other kinds of personal activities, joelblock.com is probably the best place to go. But the information on the white paper related to the opportunity zones and for information about my company. We're probably going to start an opportunity zone fund also, so people with capital gains can pour money into these types of deals. Then we'll work on that with them. So if people want to talk to me, they just go to either Bullseye Cap, which is short for bullseyecapital.com, bullseyecap.com, or just go to joelblock.com and you can navigate to the same pages from there. So there's a lot of stuff. If people are sophisticated, if they have questions, I'm always happy to take questions. And we have a whole video library. We've got a lot of stuff that people can tap into.
That's great, Joel. I so appreciate you coming on the show. It's been great to have you.
Well, thanks for inviting me. I really appreciate it. And I hope that some of the things we talked about are helpful.
That's great. And thank you, Fueling Deals listeners, for tuning in. Remember, there's only one difference between companies that grow inorganically and those who don't. And it's unrelated to size, amount of capital, or any other factor other than that the owners and executives of companies that do deals make a decision to do deals, and then they take action. It's time to refuel now. So until next week, Corey Kupfer signing out.
Thank you again for tuning in. Be sure to leave Fueling Deals a rating and review on iTunes and Google. Check out all our episodes at fuelingdeals.com to find out more resources to accelerate your business growth.